Market volatility is back in a big way. You got the Fed raising rates, markets getting a little spooked, inflation running high, all kinds of stuff driving the volatility. Maybe not so much today, but it is far from over. We have lots to talk about today. Let's go. Hello and welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, let me introduce myself. I am Michael Loftus. I am a practicing financial advisor. So what you see in this video, I do apply to our practice as a registered investment advisory firm. So if you like what you see in here, please do consider subscribing. We can also take comments now. They're open. Just make sure you're going to be nice down there. So, lots going on. Obviously, the Fed's raising rates, which is spooking the market. All kinds of things we're seeing right now underneath, on top, you name it. So today, as always, we're going to start with our cycles. Where are we? Then we're going to go to the big charts, look at some of those breakdowns, resistance, etc. From there, sector spotlights. Yeah, there are some things we are adding right now and getting rid of some stuff. What keeps me up at night after that? And there's a slew of that today, believe me. Last but not least, our game plan. We also have put below a timestamp if you want to move around. So let's go to the big board. All right, here we go. Our process starts with the cycles. As you can see, 4 cycles like the 4 seasons. Back in November 2020, we went into cycle 2, growth accelerates, inflation accelerates. As we went into this year, talked about in late December and January video, we're moving to this side of the board. Specifically, we thought a shallow cycle 4 and deep cycle 4 as well. Well, after the announcements, we definitively have been in a cycle 4 type scenario. Growth is slowing. Going to show you that today. Inflation decelerates. Yes, it's still sticky. The number one is oil right now. Outside of that, we're seeing a lot of rollover. Now here it says the Fed is dovish. They're clearly not dovish, but deflation or disinflation is what we are anticipating. So we are in cycle 4. That then drives a lot of our investment decisions. Let's go to the big charts. All right, first thing, we're going to start out on the longer end, our monthly chart. What exactly do we see here, if anything, that concerns us? Obviously, up here is relative strength. You're seeing that go down. Not a surprise. This is momentum down the bottom. Same thing. You can see momentum going down here as well. Now, when you look over here, last week we did break our 12-month moving average, but we did hold. Okay, so what does that mean? As of today, we are still positive on the long-term trend, and that should not be surprising. Next up, we have a weekly chart. We have definitively have seen some moves here. I think the biggest thing is right here, okay? This is our 40-week moving average. You can see we've only gone under it a couple times, 18, 20, and now let's see what happens. Do we hold there? The other thing is, again, same thing. Relative strength has gone down. Momentum, this is big. So we've had a negative crossover on momentum, which makes our midterm view negative for the first time in a long time. So next up, the biggest thing right now is the daily. This is what we're looking at. We're live about 10 o'clock here on Monday. Not surprising to see a push here. So what's happened here overall? Okay, obviously we have gone down. Okay, we went into what's called correction territory. Not quite. 10% is considered a correction. Right now, when you look at that, you got extremely oversold conditions, which is what we're seeing there. Okay, we've had negative crossovers, no doubt, in momentum. Okay, and volatility has gone up, currently sitting there about 26 right now. So this is the big question. what is going on and what do we anticipate? When we zoom in here on the charts, okay, I've done a couple things. I've added the Fibonacci retracements. Not familiar? We'll put a link below to a video I did on that. But it's a mathematical equation. It shows markets. So when you look at it, not surprising, right here is your 50-day moving average as well as your 38% retracement on the S&P. It would not surprise me to see us go back up as a counter trend, bear market bounce, and then roll over again, okay? Not surprising at all. That's what we're anticipating as we go forward and what we're looking for this week. Now, the big move, of course, has been in the NASDAQ. Here, on the other hand, we were down about 15% when we hit our low, almost at 20%, which will be considered a bear market. So what are my concerns here? Number one, okay, 90% of the companies in the NASDAQ 100, okay, are in bear market territory. That's a problem. Now, 24% of the NASDAQ 100 is Apple and Microsoft. They both had good earnings last week, and that's really helping it as we go forward. So same thing here when I look at it, when I look at the Fibonacci, 38% retracement, 50-day. I think we can go back up there. The question is it worth the risk to go back up there? Something I haven't determined yet. I want to see what happens, see how things shake out. We don't buy till the afternoon. Amateurs buy in the opening. Pros, you want to see buying in the afternoon. Not saying I'm a pro, but I've been doing this for a while, but I am more patient as it pertains to that. Down here is the volatility index for the NASDAQ. It has rolled over, okay, but we're still at 35, above 35 for the VIXN. NASDAQ volatility is still high. We want to be careful there. So we'll see a lot going on here, but going to determine, I think, over the next week to 10 days, our positioning. Let's go to Sector Spotlight. All right, so we've talked about the US dollar before, okay? You get the dollar right, you get a lot of things right. Now, when you look at the chart here, cycle 2, when we came into it, the dollar really went crashing down, which had a lot of effect on commodities. Dollar down, commodities up. Well, you can tell we've bottomed and we've continued to go higher, okay? US dollar is a good play as we go forward. We think it goes higher. This has been one of our smaller positions at this point and looking to add to it. And you say, the dollar, that's not a lot of fun. This shows you the monthly view, a couple things on the chart. You can see, right, I have the trend line, have an opportunity here to break out, but you can see, sure, there's still some upside potential on the US dollar, and that's one of the reasons why we've added this to our models as we go forward. Okay, next up, the 10-year. 10-year is everything right now, okay? The 10-year, I've said it all along, 10-year smarter than the overall markets, and it's telling us a lot right now. Maybe not in this chart, but in one we'll look at in a second. So a couple things have happened here. We feel that it's peaked. It's going to slowly start rolling over, kind of stuck in this consolidation mode right here, okay? We have had a negative momentum crossover. So again, Treasury go down, prices go up. Cycle 2, we weren't in Treasuries. We've been adding our positions back into Treasuries. We've got 5 different positions, and that's based on duration. You can go as long out as 30-year. The longer out, the higher volatility, but the higher potential for return. Midterm, 20-year, etc. And we have a deflation bond fund as well. So this is an area, it's going to be a big part of our portfolio, and I'm going to explain this as I go back and kind of show you the past and what we've done in the past. So if rates are going down, meaning yields, on a 10 years, there's a couple things that seem to work well, okay? You've got consumer staples, you've got utilities, which are rate sensitive. Both had good moves on Friday. You see that up again today. You've got healthcare, which generally does well. Also in this cycle, but let me be clear. When we go deep cycle 4, we're going to be out of all of these, okay? These are equity holdings. We still have some S&P. We've got some low volatility S&P. But if it goes, we're not going to be there at all, okay? The next big one is gold. Our old friend gold. Have not seen this one in a while in our portfolios. Here you can see a simple in and out signal. What is that based on? The 50-day and 200 moving day average. When you cross over, that's a death cross. When you cross above, okay, that's considered a golden cross. Okay, so you can see, and recently we have had a golden cross. Okay, so it gave us that signal. It also works well in cycle 4. Okay, here's a closer look at gold right now. So we've been slowly adding to our position here. We'll go max 12% on gold. We're not even close to that at this point, but we have been adding on certain dips. Okay, so when you look at this, you can see your trend line, right? Still have a way to go before the trend line. But what I see here, okay, is a series of higher lows. That is a bullish signal that I'm looking for. Again, have not gone all in yet, but we do like this going forward. We'll talk more in detail with our game plan. Let's go to what keeps me up at night. All right, as you can imagine, a lot that keeps me up at night. Don't forget, if you like what you see, hit that subscribe, hit the bell, that'll notify you. We also do a live show every Monday at 4:15 when we're not releasing a video, which we only do once a month on the market update. So, as an example, past performance does not guarantee future results, of course, but this shows 2018, our most recent reference when we were raising rates, okay? And you can see each time we had a 0.25% rate hike, okay? And then, of course, things came down. Now, a few things here that stood out to me. One, when we started going down, we got that death cross pretty darn quick at 6% once the market's gone down. Although we are seeing a sloping 50 on today's S&P, we're not close. Okay, so at some point we went down about 20%, but recall a couple things happened. We got the Powell put between Christmas and New Year's. They came in and said, all right, we're done, because they're freaking out the market. And then, of course, they actually started cutting rates. And the market then took off big time into this market. So what's the difference between 2018 and today? Growth is slowing. We're going to talk about that. Inflation, didn't have that. Supply chain, 14 million people not working. Housing bubble, yep, haven't really talked about that one, have we? Rates are at 0. They got to 2.4%. So a very different scenario. You take this is why the market is concerned about current rate hikes, okay? So what else? Here's some headlines. Not that you want to be moving based on headlines, right? So Fed seen hiking interest rates 7 times. Wow, that's going to be interesting. Okay, the Fed has no choice. They have to stop inflation. And if that means the stock market tanks, so be it. Yow, that's a tough headline. But that's how far backed in the corner they are. I'm going to talk more in detail. This chart shows the rate hikes, the projection. It was lower. It was actually under 4. Now we're at 4.75. Market crash hands defeat for traders who wear with Wall Street. That's the Robin Hoodies. There's a lot of people in this market right now that have been added to this market who have never been through a bear market. Going to be interesting to see how all of that plays out. So we talk about the Fed being behind the curve, okay? So we're at 7% inflation. The last time we saw 7% inflation, okay, all the way over here in March of 1982, rates, the overnight lending rate was 14.5%. Yowza! We're at 0 and we got 7%. So that's number one. Unemployment, 3.9%, the lowest it's ever been when the Fed starts raising rates, hiking. Woo! Excuse me, a lot going on there. So that gives you a good idea on what's happening there, okay? Growth, so we talked about it in our cycle. You have to look at growth. When we did our year-end review, did a video at the beginning of January, we originally were projecting 6-7% growth. GDP, guess what? The Atlanta Fed, who comes out with GDP now, just came out with their latest, probably can't see it because it's all the way down here. 0.1% growth projections. Wow, that is talking about growth rolling over. Not sure what happened, but my screen switched. But growth is rolling over. Jobless claims recently was up. Last week, every one of these points on a rate of change from last year were down, okay? Empire State Manufacturing, U.S. retail sales, Purchasing Managers Index, PMI, Services EMI, Consumer Confidence, Durable Goods, all rolled over last month and are going lower, again, reaffirming our growth outlook, okay? All right, so what else keeps me up at night? New highs minus new lows on the NYSE. Show this chart frequently, tells us what's going on underneath. I could show you a lot of charts that shows deterioration. The black line is the NYSE. You see that go down. In the back is the histogram. It shows new highs for the day minus new lows, okay? Pretty simple. Over here, we had a lot. That's showing strength in the market. Now, Friday, even when we had that push to the upside, we had 532 negative lows. So that does not show a lot of strength in this market right now. So that's something that concerns me. Put this out on Twitter and Facebook. If you don't follow us, I'm always putting out charts with some headlines. High yield spreads, have to follow it, okay? High yield spreads is the difference between 10-year and junk, okay? Now, it is compressed, it has broken our trend of 3.3. You can see when high yield spreads go down, what happens to the S&P, the cost of credit. Now, we're coming off a cycle we have never, ever, and that's a long time, seen high yield spreads this low, okay? The complacency in the market, the cost of credit, even junk was priced so low, and we are starting to see a move up. Have a little bit of way to go before I'm really concerned, but we'll continue to watch this. The next one, the easiest, the most accurate indicator for recessions. 10-year Treasury minus the 2-year Treasury, that's called the yield curve. After they came out last week, meaning Chairman Powell, it went down 13 basis points in one day. That's a massive move, okay? When you get below zero, okay, that's where you see that recession, okay? I've only gone back here to 2020. I can bring that in my next video. Now, 0.63 was Friday. As of this morning, we went down again. We're at 0.59 on the yield curve. That's concerning. The bond market is clearly telling us something completely different from the stock market move from Friday and today, okay? And I'm gonna take the bond market's position on this one. So let's wrap it up here. What's our game plan? I think you've heard it, right? We're gonna follow those cycles, all right? We've got some cycle assets we're bringing in, adding. I'm actually at probably my max. I'll go as much as 6% on one of those sectors we talked about, utility staples. I'm actually less than that because I think the volatility is too much to go in there, okay? But the yield curve, we have to watch that. No doubt, you saw me talk about that. Transition your purchases, right? Bonds, cash, and gold. Yes, cash. Cash is king. We've got some bond alternatives with high yield, short duration that we will go to. Opportunities, sell, and strength. So if we go to this 50-day that I'm anticipating, probably start selling some more, put in some hedges. Got a video coming up on hedges in a bit. And of course, I should have said this at the very top, follow us for updates because we're always putting stuff out there on the various social media platforms, charts, articles, and again, our live show every Monday. Michael Loftus, Wealth and Wisdom TV.